And so who am I? Why am I talking to you? Well, for one, thank you for joining, especially if you don't even know who I am. If you don't know who I am, my name is Jason Stubblefield. Started investing in apartment buildings in 2016, grew a portfolio, had a little over 1,000 units. Multifamily is my business, right? It's sort of what I do. What you're looking at right now, if you can see my screen, is my website. That's snscapitalpartners.com, like Sam, Nancy, Sam, capitalpartners.com. You find out more about me, you find out some of the investments that we've done, investor conversations, stuff like that. If you are an investor and you say, hey, I want to see some of the deals that you all may do, click on the invest tab right here. Join our community. There'll be a brief form for you to fill out. And then once you do that, you'll sort of get brought into our world. We'll have a conversation, see if there's something that we have that may work for you. So other than that, that's the quick brief intro. Now let's go ahead and hop into it. So I'm ready to get rocking and rolling with this. So I'm going to share my screen. I like walking through this document and taking some notes. And there's some very smart people around. I like keeping smart people around me. So if I say something that's not right, correct me. If you have anything to add to my documents here, feel free to chime in and let me know what's going on there. So just starting off here, I see the chat's coming in, so y'all can see my screen, correct? Give me a head nod if you got the camera on and you can see it. Good deal. Good deal. All right. So is it a good time to buy multifamily? Disclaimer, right? These are just my thoughts, right? You could take this and use it or not, right? I encourage you to do your own due diligence. This is just Jason Stubblefield telling you what I think, right? So I think legally, I got to say this is not investment advice, and it's not. Okay. With that being said, let's go ahead and hop into it. Who remembers 2008? Head nods, thumbs up. Put it in the chat if you remember 2008. All right. So in hindsight, if you would go back to 2008 or 2009 or shortly after when we had this housing market, for me, if I could go back, it would have literally been buy everything you can, right? Because that was a great time knowing what was going to happen. And so I think that a lot of the information that you hear, like, hey, now's a great time to buy or you should buy, sort of comes from 2008. But you want to know more than that, not just like, hey, when the economy gets bad, go buy stuff, even though personally, I think that may not be a bad investment strategy. But let's see if there's some data behind it. And I'm going to try to run through this relatively quickly. So to me, it all starts with interest rates. So why are interest rates rising? What's going on with that? Historically, since 2008, from that last crash up until this present moment, interest rates overall as a whole have been going down, and now they have started to rise. And sort of what's fueling that? So we have an inflationary economy now. Gas is up, housing is up, everything is up. And so from the Federal Reserve, who dictates our interest rates, they have deemed, and this is just me observing their behavior, that an inflation is more of a concern than a recession. So if you think about it, it makes sense, right? So yes, you have stocks are crashing right now. You've got crypto is crashing right now, right? Everything's crazy. Layoffs are happening, right? But at the same time, the Federal Reserve continues to increase interest rates. And like, what are you doing? Usually when the economy goes bad, they drop interest rates, right? Well, the reason that they continue to go up is because inflation is more of a concern, right? If you have runaway inflation and it doesn't get put under control, that can be very bad for our economy, the country as a whole. And so Federal Reserve has really come out and made a line in saying, hey, we're going to fight inflation. So what that means when it comes to returns, though, is that something's got to change, right? And so if you were to invest in a property right now and you say, I'm going to get a return, right? You were an investor, say, would you take 2%? Would a 2% return on your money influence you? Probably not, right? So it's like that for you and it's like that for the market. And so even though interest rates are going up, what that means is there's less cash flow available to be distributed to investors, okay? So as less cash flow is available, then that means that if you want the same return, there's only certain things that you can do. There's only so many levers that you can pull. And one of those levers is going to be price, right? So if its interest rates go up and you still want the same type of return, and you're not going to take a 2% investment or a 4% investment, you're still looking to get that 5, 6, 7, 8% return on your capital, then the only lever you could pull is on price. And so you're starting to see price goes down because of these interest rates, and interest rates are staying like that for a period of time. So let's just take a look at history to see what happens when it comes to interest rate. And so this is the Fred's research out of St. Louis. I want to blow this up so y'all can see this. So this is interest rates going back to the 70s. And I'm not going to spend too much time on here, but I just want you to see patterns here, right? So we have areas of rising interest rates. You go over here and you look, what is this? 1979, 1980. I mean, interest rates were way up at 18%. Okay. And after that, they sort of come down. That's the Paul Volcker period, right? Really wanted to tame inflation, right? That's what happened during that period. There was runaway inflation, interest rates went crazy high, and then afterwards they started to come down. And so if you look over the past from 1980 or so until now, you start to get a pattern. And I've zoomed out of this thing, so let me back up to where I was, so I can get it back looking how I was prior to that. So if you go back to the 80s and just follow what's happening in interest rates, you see a pattern. And this pattern is interest rates skyrocket, they go up, and then shortly afterwards, there's a decline, right? And that pattern since 1980 has always held true. And also you start to look at the time. So I'm here at 90, what is this? 94, they're at 8%. Go all the way up to 9%, and then by 95 they're back at 7%. So like a 1 point reduction in interest rate costs. And so what happens? Usually the Federal Reserve raises interest rates in order to cool off the economy, and then once it cools off, they drop it again, right? And so if you just understand this pattern of what's happening, you can sort of, not to say that it's always going to be like that, but you can use historical data to try to predict the future. And so if you look way out here where we are right now, this is what you see in this drastic rise in interest rates from where we are just in February of last year, being at like 2%. And now it's up to, what is it, close to 7%, right? So you're seeing that. And so if you look at the pattern over what's happening in this chart, well, what do you think will happen eventually, right? Maybe it's 2023, maybe it goes out a little bit further to 2024, but it seems to me that at some point this trend is going to reverse, right? And so if prices are being reduced naturally off of multifamily as interest rates go up, when interest rates go down, those prices can increase, right? That's interest rates historically. Now let's look at the national debt, right? If we go to here, right? So Investopedia talking about interest rates hikes and how they may add $1 trillion to the national debt interest. So why are we talking about this? When the Federal Reserve increases interest rates, that goes throughout the whole economy. It also means that as the government borrows money, they have to pay back a higher interest rate as well. And so this is a great article, I'll share it with anybody who wants to see it. But what they're talking about right here is that based on the national debt and these interest rate hikes, there's a growing amount of the economy's money that's just going off to service the debt. And every time interest rates go up, more and more the economy income has to go to just servicing the debt. When that gets out of hand, right, it's no different. The economy as a whole works like you as a person. So if you all of a sudden, all your debts go up and they double in interest rate, then the amount of money that you have to allocate in order to just servicing the debt goes up, which is bad for you as a person. And it's also bad for the country. So with that, with the national debt growing how it is and interest rates rising, there is a pressure, right? A pressure on the Federal Reserve to lower interest rates. So for those two reasons, right, you say like, hey, for one, historically, interest rates, they're risen and then they come down. And yes, I will go ahead and share that right now. Ash, it's coming your way. Right. So as those interest rates come down, and also as you have this pressure going to this pressure coming from the national debt, you can make the assumption, right, that you can expect interest rates to fall in the coming years, right? If not next year, latest 2023 or some point. But that's an enormous amount of pressure for those, right? And so you say, all right, so if now is a bad time for us to, if it is a bad time for us to sell, right? Why would any properties go to market right now? Why wouldn't everyone just not sell? And I think for the most part, that's true, but there are some things that are sort of unique to the multifamily space that will keep properties coming. Typically, one of those is loan terms. So loan terms in commercial real estate is usually 3 to 7 years, right? Sometimes a little bit longer, maybe a little bit shorter, but it's 3 to 7 years. What that means is that every property that was bought 3 years ago or 7 years ago or somewhere thereabouts, they're coming up for renewal. And if, well, we already know the interest rates were lower during that time, refinancing just doesn't work as well in this market. So if you have to do something because your loan is ballooning, you're at the end of a term, then you may decide to sell where you would otherwise refinance or something, just because you want to get out of that other debt, and going into new debt doesn't necessarily make sense, right? So that's going to cause properties to come to the market. Refinancing doesn't work well. And also you have expiring interest only periods. Over this last few years, there's been a lot of properties that were purchased on interest only. So you had 1 year, 2 years, 3 years, 5 years of interest only, but now that's burning off. And so whereas that helped to force appreciation, because people could be riskier with their purchases because they weren't paying any principal payments. Once that burns off, if a property isn't performing as well, then now they have to pay principal and interest, and that could trigger properties to sell just because it's too tight. They're not profitable once those principal payments actually kick in, right? So that will be the condition of properties that come to the market. Also, bridge debt, right? So this is where the entire term was only 1 to 5 years, and those were usually only interest only payments, but those are going to be ballooning as well. So if you bought off a bridge, you've only got 1 to 3 year term, that note becomes due. If you thought that the market was going to stay where it was and now it's changed drastically, right, you have no choice but to sell. And even worse, if you bought one of those properties on a bridge note and you did not purchase a interest rate cap, do not want to be that person right now, because your properties, your life has gotten drastically worse, right? You've seen your mortgage payments almost double. And if you didn't put an interest rate cap on, it's painful. So you will have properties that are coming to the market where they didn't purchase an interest rate cap, the end of the term is coming, and they just need to sell. And then also you have just regular life stuff that happens, right? Owners get tired of operating properties. They decide to just move on. And you also have where people just executed their business plan. And so properties, like, we may be bringing a property out next year to sell, not because we're distressed or anything, but just because, hey, we feel like we were conservative in our projections. And even with interest rates going up, it's still, we basically executed the plan, and it's a good time for us to sell. So those sort of properties will come up. So all this to say that just because the timing may not be ideal in the commercial space, it's harder to just hold on and say, I'm not going to do anything, because of the nature of commercial real estate and the shorter terms that usually go along with it, right? So does that make sense to everybody? Any questions about that? So, all right. So now let's talk about rental demand. And here's where I want to get y'all's feedback at. So tell me right now, if you're on the Zoom call, you put in the chat, if you want to unmute yourself, whatever. But are rental prices going up, or are they going down right now? No, is it going up? Up. Jacqueline up. Ash staying put. Okay. So y'all are saying that rental prices are going up. Cool. Let's take a look at it, right? So you'll have some internet articles today. So I'm going to bring this up. Business Insider. Where is this one at? All right. businessinsider.com. For those who said rental prices are going up, you are Not correct. Catalina, you came in late right there. We just said down. She said down in some markets, but you're right. Rents are starting to fall across the United States, and they're expected to drop even more. So if you go through this article, I just want to highlight some of the things that they say in this article, which is a very good article that they mention. But here, in fact, rents across the U.S. have already started to decline in some markets. Data shows that the third quarter of 2022, national asking rents declined by 0.4%, reflecting a shift from just a year ago when demand drove prices to historical highs. So, well, Jason, what the hell are you talking about then? If rents are going down, then why would you say it's a good time to buy, right? And if you ask me that, that would be a very good question. So I want to look at another article, and this one is coming from let's go to CNBC, right? So scrolling to the top of this, rent prices will keep going up in 2023. So now that's conflicting, right? We just saw an article from Business Insider said that rents are falling, and now CNBC says the rents are going up. And so in this article, they hit it right here. Despite some good news about U.S. rent prices falling in August, the long-term outlook doesn't seem to be promising. And so they talk about one of the bigger motivators of rental demand staying high, and that's rising home ownership costs, right? So mortgage expenses, the cost of trying to get in the house has nearly doubled, according to this article, right? And so what they're talking about is that above average rent price gains in 2023, right? So year-over-year rental price growth will rise from 5.8% as of June of 2022 to 8.4% as of May of 2023, according to the Federal Reserve Bank of Dallas forecast. So we got one article saying that rents are going up, and we got another article saying that rents are projected to go down. So what's really happening right there? And that's why I want to break to the third article here. And this one is from apartmentlist.com, another good website for you to check out. But let's just go ahead and get to the data, right? Y'all can search the internet on your own, but let's get to it here, right? So rents nationally fall by 1% month over month, yet it says prices are still up 4.6%, right? So the national median rent increased by a record-setting 17.6% over 2021. All right, so let's put all this into perspective. So when rents are going down, it has to be going down in comparison to what? So it's going down in comparison to a record-setting 17% that it was going up. So if you had an extraordinary, unsustainable amount of rental growth, and you read articles that say rents are going down, that's absolutely right. It's not sustaining the same level of growth as it once did. However, if you look at year over year, the rental prices are still going up. And so hopefully that makes sense. So you can make sense out of the data as you start to research. And this is why you can't really depend on just what an article says, because those people who don't take the time to research and understand why these articles are being written and sort of look at it from the other side, you'll take one headline and sort of run with it. But what's happening is rents are coming down, and that is because they're not staying at the all-time record highs that they were. The growth percentage is actually declining, but the overall rental amounts are going up, right? However, they're going up by a smaller percentage. So the way my company buys real estate, and the way I would encourage you to buy multifamily real estate, is to make sure that you're not buying properties that are at the top of the rental projections for that market. You want to find something that has some meat on the bone, that has some level of value add component to it, so that yes, you can increase rents, but you're not going up to the very top of the market. So if you understand that historical growth, it's not going to be growing by 17, 18% anymore, okay, at least for some period of time, but the overall growth is still going to be there. And so for that reason, I'll go ahead and try to bring this to a close, right? So you have continued supply coming, right? We talked about that with the amount of just notes that are being renewed, the amount of bridge debt that's out there that's going to be coming to the market. Interest rates are high right now. However, the ability for those to be sustained is highly unlikely, my opinion, right? So there's definitely some pressure on those interest rates to come down. And you also got continued rent growth, right? So that's what we just looked at, right? So it's not going to be growing by 10 and 15% like it was, but it'll still continue to grow, however, at a slower pace. So if you understand that and you sort of are able to take this data that we covered here today, think about 2008. My opinion is that now is a great time to purchase properties, not to be foolish, right? Because it's never a time to be foolish. But if you understand the data and understand what you're doing, and then you strategically look for properties in markets that have growth, right? When this thing shifts around, when interest rates start being lower, you're going to be in a great position to take advantage of that. And honestly, that's where millionaires are made, right? When you learn how to own property and get in and out of properties at the right time. So there's no perfect timing, but if you can look into a crystal ball from the data here, I feel strongly that this is a great time to buy. That's the action that I'm going to be taking going into 2023. And hopefully I've been able to share some information with you all today that if it doesn't encourage you or influence you, at least it gives you something to think about when you think about, hey, what do I want 2023 to look like for me when it comes to multifamily real estate. So any questions coming in from Zoom, any questions coming in from Facebook?
So a quick question, perhaps Jason and Chad and, people like that can answer. What is the anticipated reduction in rates? So like maybe like what do we think? 5.5, 5, 4.5, how low will they fall? And roughly how soon? Just a rough estimation.
Chad, you want to take a stab at that?
Yeah, so the Fed produces a document that it's called the dot plot document. And it's where all of the people on the board of governors make their predictions of future interest rates. So I would refer you to look at that. I actually read an article about that this morning, but I don't recall the exact data because I just quickly glanced at it. But the market is predicting that rates are going to come down sooner than the Fed dot plots are indicating. So the debt markets are more optimistic. The Fed is putting out those numbers because they're hyper focused on inflation, as Jason said, and really focused on the labor force component of it. Just kind of the top of my head thoughts.
What's the article you said, Chad? Where can we find it?
It's probably right on the Federal Reserve website. I get it emailed to me, but it would be easy to find. It's just called the dot plot by the Fed. Dot plot.
DOT? Plot.
Yep.
Okay. Thank you.
Yeah, it's just a series of dots.
Oh, okay.
Yeah, it's not very fancy.
Thank you.
So I'm familiar with that. They mainly go through and the people who are way smarter than me make their projections about where interest rates are going, and they also price in the debt markets according to that. And so it's something that we look at. And so overall, what Chad was saying is exactly how I feel, right? There's a lot of pressure for these interest rates to drop. And once they do, I think what you're going to see is a lot more activity in the market. And then those who are able to buy during a time where there's some fear in the market or uncertainty, right? That's a great time, because when that fear and uncertainty goes away, now you've got more of a buyer pool there that you can take advantage of. So yes, it's like weathering the storm right now to try to get through this. But great question with that. I don't know how low it will go. I just don't think that this level of increases is sustainable for too long a period of time.
Yeah, I think the debt markets are saying that it'll likely slow down and maybe decrease mid next year, and the dot plots have it going up higher and longer and then coming down, and to be roughly flat to where we're at now a year from now is kind of what my overall thoughts are. Yep.
Good stuff. Thank you for that, Chad. Anything else? Any other questions coming in?
So I'm sorry, Jason. If there's nobody else, I'll go ahead and
Go
ask the
for it.
question.
Go for it.
Okay, thank you. So generally, has been your experience? How much of suppose it's a $5 million deal, how much of that goes into like taking a debt versus how much of that money, of that 5 million is funded through a syndication, 2 million comes out of syndication and 3 million is then taken as a debt. I mean, roughly what have you experienced in your
Yeah, so interest rates have an effect on that, Ash. So
Okay.
When interest rates are low, usually the leverage that you get from a bank could be higher. So you may see 75%, 80% leverage coming from the lender, and then you have the remaining amount coming from equity. Or as interest rates go up, obviously there's not obviously, but there's a debt service coverage ratio that you have to meet. So the lender's looking at how much money you're going to have to be able to pay them back. And as the interest rates go higher, the amount of money you have to pay them back goes lower. And so the amount of money that they're willing to loan you goes down. So right now we're seeing debt quotes come in, sometimes 65%, sometimes even lower, right? So you're not getting the maximum leverage at this point, which puts pressure on prices, right? So if everyone's looking at the same data and lenders saying at that price, I'm only going to loan 65%, well, naturally the offers are going to be lower, right? Let's say, hey, we can't get as much debt as we thought on this. So now we can only get, now our prices got to go down to try to maximize our loan proceeds.
Thank you.
Okay. Lane says 55 to 65%. Yes. Yep, that's what we're seeing. Okay, great. Well, if nothing else, right, I appreciate y'all for joining with me during this Christmas season. You could be out shopping or working or doing whatever right now. Definitely a lot going on, but thanks for joining in for this talk about multifamily, trying to gear up for 2023, and hopefully you got some useful information out of what we discussed here today. SNScapitalpartners.com is my website. If you want to check out, hear about our investments. Also, if you're looking to make a move, you want to start investing into 2023 and you like some help doing that, feel free to reach out to me. We can discuss how we might be able to assist you. Other than that, have a great weekend, and I will chat with y'all next week right here. All right, see you.